What is going on, beautiful people? Happy Friday. It is PPI day, inflation day. And so I want to make a quick video talking a little bit about the numbers that came out today. We'll hit on CPI, Consumer Price Index numbers that came out earlier this week. And then just take a couple minutes and talk about some of the banking craziness going on right now. We talked about that with our team on Tuesday, and I thought it'd be helpful to just make another follow-up video that kind of explains a little bit more about some of the nuances that are scaring a lot of people right now in the commercial banking world. So, just really quick, I mean, this is a type of video I used to make for the brokers that I owned, and I no longer own that broker, so I'm gonna start making these just for everybody and not just for a small group of people. Just talking about, in my opinion, some of the important headlines that are coming out this week. So the first thing we'll talk about is today's inflation numbers, which, like I said, were definitely, let me share a screen here. This was the sentiment. Inflation comes in hotter than expected, 0.9% in January in the producer price index, which you got to keep in mind the producer price index, the PPI, is basically the lead measure. This is what the producers are feeling. We feel, the consumer feels, the CPI, the consumer price index, which is what we saw earlier this week, which also came in harder than expected. So the PPI rose, it was expected to rise 0.7%, and it rose 0.9% year over year. The core was expected at 1.6%, and we got a 2% reading on the core. So the important thing in this is to go over to the Fed Watch tool so we can see right now where people are expecting rates to go. And so we've talked a lot about how throughout the last 6 months, the market has been pricing in as many as six rate cuts, and Jerome Powell has been saying fewer and not till the second half of the year. And now we're starting to see that that's actually probably the reality. And so here in the Fed Watch tool, we can see that, in the next meeting, 91%, 0.5% chance that rates stay where they are. And the blue is essentially where the projections are that they end up. And so we are being projected to possibly see probably around four cuts this year. And if inflation continues to get hotter, that goes down even more. But to get to this point, where we're 1% lower Fed funds rate than we're at today, we're talking end of 2024 or beginning of 2025 is where, if you looked at this 3 months ago, 6 months ago, these blue boxes would be all over here, and it was all much more likely that we would see cuts much sooner and much more often. And the market is now starting to price in basically what Jerome Powell's been saying. So very interesting stuff there. This is definitely what a lot of people that have been maybe not as convinced that inflation is under control have been saying for a while. And we're starting to see some signs that it's remaining sticky. A lot of people have said that, getting in too far past that 3% inflation number is going to be pretty tough. And so that's definitely what we're seeing. But let's take a minute now and talk about some of the things we're seeing in the banking world. And there's lots of concern right now for several reasons. I mean, one is that there's just a lot of people moving money out of deposits in banks. And so banks are having a hard time. Their projections are over $1 trillion of deposits have been removed from banks, which for the most part is because they can get better return elsewhere. You can go buy a treasury bill for over 5% as opposed to keeping your money on deposit in the bank for 0.1%, or lots of banks are now offering for high yield checking accounts much better rates. But if you had money sitting in a savings account for earning next to nothing, you're going to take that money and put it into treasury bills. And so you're seeing a lot of banks kind of scramble to not match but get somewhat close to what T-bills are offering. So the other piece that a lot of people are concerned about right now is commercial mortgages maturing this year. And so the reality is a lot of, commercial mortgages are very different from residential mortgages in that they're not on these 30-year fixed terms. They're typically, 5, 7, 10-year adjustable rates where after that term is up, you renegotiate that loan. And so the original projection was that maybe around 12% of commercial mortgages were going to be coming due in 2024. And that number now is projected around 20% of commercial mortgages that will need to be refinanced right now. And so you picture these mortgages started, 7 years ago, let's say. Well, what were rates in, 2017? That we're looking at mortgages that are just night and day different in terms of where the interest rate is, but also in terms of value of the property, as lots of especially commercial properties are maybe they were 80, 90% occupied at that point. Well, refinancing a 50% occupied properties or building is much more difficult than a fully occupied commercial building. But then the third piece is that the lending requirements are way different today and much stricter, especially in commercial real estate. And so there's certainly some challenge in refinancing these properties because the projection at that 20% is 929 billion dollars worth of commercial real estate that needs to be renegotiated this year, which is pretty significant. And you got to keep in mind too that the majority of this isn't held by national banks. A majority of this is held by regional banks. Goldman Sachs projects that about 80% of all commercial real estate loans are held by regional banks. And that brings me to my next talking point, and that's that regional banks have been struggling for the last year. You know, a lot of you remember Silicon Valley Bank having a pretty significant challenge in March, where there was essentially a run on the deposits, and out of concern for the safety of their money, depositors went to withdraw what they had held in that bank. And so as a result, the Fed set up what's called to protect Silicon Valley Bank, but also to demonstrate to other banks the Fed's willingness to backstop any concern. The Fed set up what's called the Bank Term Funding Program, which I'm going to show you. Let me share the screen here, which just demonstrates essentially the deposits for the Bank Term Funding Program, which was originally set up as like a line of credit for regional banks to draw on to essentially, you know, when they receive deposits, they of course don't just sit it there in cash. They put that money to work. And oftentimes that money was put to work at a much lower interest rate. And so when all of a sudden people expect a higher return and the banks aren't getting that return and there's a run on this money, well, they need to go borrow money to make people whole on their deposits. So the Bank Term Funding Program was a line of credit for these banks to draw on. And you can see in the first couple of weeks, I mean, we went up to 60, 80, $100 billion of money loaned out by the Fed for these banks. And then it stayed around that for a majority of the last year. But towards the end of 2023, it was announced that the program is ending. March 11th, 2024 is when the program is no more. And so that also meant that people weren't going to be able to draw any new funds from this line. And so we did see a run again, got up to almost $180 billion out that banks borrowed. And it is due on March 11th, 2024. $168 billion is now what's due. And there will, of course, be repayment program set up with a higher interest rate for that money to come back for those that can't pay it back right away. But the point is, a lot of these banks that had this lifeline are potentially going to be struggling if they can't pay this back. So there's a lot of signs right now of cracks, of concerns, specifically in the commercial real estate world. So that's just a couple of things that people are keeping an eye on in the banking sector of why there's some concern right now. And I think it's things that we got to keep an eye on and watch. It's a very interesting time. I think 2024 is going to be a very critical and pivotal year for the economy, for the real estate market, for the banking sector. And there's a lot of people projecting that if we do see any sort of significant downturn this time, it's going to be because of banking collapse. So keep an eye on those regional banks. I can't give investment advice, but if you are one that likes to bet against regional banks, there are some ETFs that are available to be either gone long on or gone short on, depending on whether or not you think regional banks are going to go up or down. So hope that's helpful. A couple things to keep an eye on, and hope you have a great weekend.